Thanks, Marty. Good morning, everybody. Thanks for being there. Thanks to the organization team for this event and for inviting me. I'm a global macro guy, so no bottom up, no for that I have partners. So I will speak about the cycle and the spreads to make it simple. There are many subjects currently from the global macro point of view, and we will try to go straight to the points. In order to speak also about investment conclusions and to have time for some questions. If you want to interrupt me and ask questions, please don't hesitate. I will start with what is usually the end of the journey. That is the preference matrix or investment or asset allocation I produce on a regularly basis every month, or if I need some updates sometimes in between two publications, I do it. It reflects my analysis, our analysis of the global macro cycle and the valuation matrix of the different asset classes. Conclusion straight on, and what I will try to show you now is that we are in a late cycle period. That means that you would favor defensive strategies in terms of sector, in terms of strategies, in terms of asset classes. It means you will favor capital gain, you will favor, carry strategies, not capital gain strategies. Those are, as you know, the two engines for profit on capital market. Of course, in a rebound phase, you will favor more dynamic and cyclical and capital gains strategies, less carry. So that's where we are now with an emerging market bias that we have for some months. The asset classes, all of them, the FX, local currency, hard currency, equities have performed quite well. Also, thanks to the depreciation of the dollar, we advised our clients over the last weeks to reduce somehow this positioning. That's what you see here. This small black round means last month. This means this month. On that side means overweight. On that side means underweight. It's not because I'm underweight, and I will explain why strongly underweight the US overall, that you cannot be invested in equities. We were quite overweight in emerging markets. Point one, point two, you can favor defensive sectors, okay? And that's what I will try to show with a European example. Every month we look for a thematic, a way to read through what happened and to discuss the situation with our clients. We always try to be a bit ahead of the curve. For example, in February, it was not a main thematic yet. Then we explored the Japanese situation. We are long Japanese yen since July, before the big volatility spike in last August. In our view, the Bank of Japan is behind the curve quite clearly. And there is an open debate today if Japan is out of deflation or not. The government says not yet. Of course, they have huge amount of debt. They have no interest in much higher rates, whereas the central bank starts to feel they are behind the curve. So imagine the Bank of Japan has to hike rates as the Fed had to do because they were behind the curve. That would trigger huge volatility on the market. That was in February. Last month, we talked about the dollar. We shorted the dollar in January. In January, it was not mainstream, believe me. Now it is mainstream. And first, about the debate that is today about the loss for the US as a world currency reserve, we think those talks are exaggerated. The share of the US in foreign exchange currencies started to go down for many years. It will continue to do so. It makes sense, but we don't believe from tomorrow, in a few days, in a few weeks, in a few months, the dollar will explode and the US will lose its reserve currency status. Nevertheless, it's still overvalued. The depreciation of the dollar is not finished. We could only have a small pause. That's why we advocate with our clients to take some profits on their short dollar positions if they had followed us. The tariffs, we will have news. That was 2 months ago. We will have news in beginning of July. Will the tariffs of the Liberation Day be postponed or will they be implemented? We will know that. It's quite complicated to calculate the exact impact on growth. You know, it will depend on substitution effects on the demand side, on the supply side, and we don't have these figures. You can be the IMF, the OECD with 200 PhDs working on the matter. We don't have the data. We will have to see what happens. And it's today quite interesting to see that the macro guys expect an impact that is quite reasonable, something about 0.7% down on growth, whereas the expectations of consumers or entrepreneurs, etc., expect a catastrophe. Who will be right? And that we will have to monitor it with the real data. That is the big question, okay, for the next 3 to 6 months. So tariffs, one thing sure, lower growth, more inflation. That's also what the Fed says. And we will see in what magnitude, depending on the decision of Trump over the next days and weeks. So every month, a new thematic. We go always the same
Yann, can I ask a
way.
question?
We always follow the same process. First, we assess where we stand in terms of cycle. Nothing complex, growth, CPI, central banks, credit dynamic, 4-phase, recession, rebound, recovery, late cycle. We are currently late cycle. What does it mean? It means that growth has started, obviously, to decelerate. Inflation is following with a lag. It means also that the central bank has stopped hiking rates. It has a neutral bias. It has not turned dovish yet, but it has a neutral bias. And the credit cycle starts also to decelerate. That is a late cycle phase. It started, in our view, by the end of Q2 2024. It's lasting a long time currently. Why? We all know the reason. It's because of fiscal deficits. Okay, always keep that in mind. The fiscal deficits, not only in the US, worldwide, weighted by the GDPs, we are above 5% fiscal deficits. You have fiscal deficits in Poland, in France, in Australia, in China, everywhere, in Brazil. So that really saves the cycle currently. How long is it sustainable? That is the question. That is why we have tensions on long-term rates for some months now. Okay.
Hey, Yann, we have a couple of questions here. Yann?
Oh, okay, already. Fine.
Yeah, Yann, I'd like to ask a question. I'd like you to address short-term, intermediate-term, and long-term perspectives on your comments in terms of investment. For instance, obviously tariffs have an impact on the economy, but so does the trillions of dollars that are coming in from outside sources. Trump is trying to restructure the world economy in addition to the U.S. economy to become more self-sufficient in terms of the U.S. How do you address that in terms of the billions of dollars that are going to come in from foreign countries to create the growth in this country? How do you address that? Is that a short-term, intermediate-term, long-term aspect? And what do you feel the consequences are? How do you adjust your investment decisions that way?
Okay, that's a very good question. The first important point in your question is time horizon. Okay, what time horizon do we look at? The second remark or answer I would do is you currently have in prices, in equities and credit spreads, so risky assets, you already have very rosy scenarios that are integrated in the prices. So current levels of price to earnings, price to books, etc., or spreads, already suppose that the Goldilocks, so the plan that the current administration has, and it's still a plan, is already in the prices. That's my second remark. My third remark is those are plans. Will it work? I don't know. So my balance of risk is skewed to the downside. I don't know if the good news or the plan will effectively work. In theory, the plan starts with slower growth, higher prices. It means a long end in interest rates that doesn't want to go down. And on the market, on the 10-year yield, you are at 4.30, 4.50 roughly. But for the end consumer on credit cards, you are above 20%. For SMEs that lend to invest, you are around 10%. So all this weights on the investment and consumption perspective. So to contest more precisely your answer, it might work, but in the longer term, I think before it works, we will go through potentially a recession. I didn't make any recession call yet in the US, despite, I show you the slide B, despite these kind of indicators, the leading indicators from the conference board. They mentioned Friday that we are in recessionary territory because the economy still creates jobs. The non-farm payrolls are still on the positive side. Once non-farm payrolls start to destroy or to be negative and the economy starts to destroy jobs, then the risk will be quite high. And that puts us Q3, Q4 as good candidates. Will it happen? I don't know. We will see. It's really an uncertain period. What will happen with the tariffs? It's completely different if we have 10% for everybody or if we have the Liberation Day tariffs.
Yann, I have a question. Can you go back to the first slide where you're talking about the dollar decline? So any thoughts on the role of stable coins? Because I'm reading an article here and it says that right today, based on this Genius Act that was just passed, that stable coins are about $150 billion of US dollar representation. Right now, the United States has about 70% of all stable coins in the world, but they expect it to go to $2 trillion in the next 2 years. And Amazon and Walmart have both announced stable coins that they expect to get rid of credit card charges going forward. Any thoughts on that?
I'm not long, so
So what I'm saying
have
is
no idea. I mean,
the demand
I saw that there is this new law. I'm aware of that. Will it develop as quickly as that? We will see. Again, it's the future. One of my partner is a specialist in DeFi and crypto, and we have an offer in terms of investment of funds, etc. in that world, in that field.
I'm just saying that stablecoins drive dollar purchases, right? Number one. And number two, China is the biggest buyer of Tether, for example, in the world right now. It's buying 50% of all Tether that's coming out. It's coming from China, right? Because there's a demand, obviously, with crypto to buy crypto there and then convert it here, right? So anyway, it's just food for thought. You can keep on going.
I'm a very strong believer in Bitcoin. But Bitcoin, Solana is another one. So every crypto is a bit different. The first difference I always do is between proof to stake and proof to work. I strongly believe in proof to work cryptos and so the stable coins that are linked to that.
Yeah, my only observation is that because you're saying the dollar is overbought, but the stablecoin law that was just passed requires that you have a $1 reserve for each $1 of stablecoin that's purchased. So that might drive more demand for the dollar. Anyway, I'm not sure. I had to talk to a crypto economist about that sometime. So, but anyway, keep on going.
Yeah, it's better. You know, I'm rather traditional finance, even if I understand the stuff. But that's a good point, and that could support the dollar a little bit, the fiat currency that obviously needs it. Uh, so
Let's keep going.
let's start. Uh, Interrupt me whenever you want. Emerging market resilience. What they did work so well. Local currency bonds brought more than 10% year to date. Here you see the FX, the different big currencies that illustrate this remarkable resilience of core emerging markets. I don't speak about Kazakhstan, Ghana, etc. I speak about emerging markets that are in the OECD or the G20. Is it luck, chance, or are there good reasons behind that? For me, there are at least three good reasons behind that. A better governance compared to 10 years ago, balanced current accounts everywhere. You have now very few current account deficits. And last, the South-South trade that is growing year to year, and that makes those countries less reliant on developed markets. So that is something I wanted to notice with my clients, that this has changed somehow structurally, the resilience of emerging markets. So we start with growth always. Where do we stand in terms of growth? We spoke about the US, about the recession risk. That's where we are. April, May, June data should be a bit softer on the demand side, as we had a lot of front-loading behavior on the consumer side and investment side. And the retail sales that just came out showed us that is indeed the main risk. By the way, Q1 GDP consumption, contribution of consumption has been quite weak and is decelerating, obviously, as a normal pattern in a late cycle. A few words about Europe. We had 0.6% growth quarter on quarter, which is a magic for Europe. But you have 40 bips contribution from Ireland. Okay, so don't be illusioned about potential growth in Europe. It has not changed. Here you see Germany 0.4%, France 0.1%. This is the weak link in Europe. Italy rather sluggish, around 0.2%, with very problematic productivity gains issues. Two words about Germany. There has been a change in the fiscal stance. Don't dream, nevertheless, too much. 500 billion over 10 years, that represents 50 billion per year in an economy that weighs 4.5 trillion. That will not change the big picture. Nevertheless, it's a good news. Okay, so the news are rather good in Europe, but the expectations are somehow a bit high, and the positive scenarios again are already priced in. So in Europe, same story. You must really choose the sectors you invest in and the kind of strategies. Growth about in emerging markets. I spoke about it. It was fine until the end of last year, and except Brazil, domestic demand are slowing. So another big part of the world where growth is decelerating significantly, and that is before tariffs really step in. Two words about China. A good news there, or something remarkable, is that the housing prices have the second derivative turned positive. It means prices are still contracting, but less than some months ago. The big picture, nevertheless, does not change. We are still in deflationary dynamics there because of demography, because of strong overcapacities. A country that depends exclusively or almost on external demand and government support, be it on the supply side as on the demand side. So there, rather stabilization in a deflationary dynamic. No big, from the growth and macro point of view, no big positive news to expect. All the more as, again, the trade war I still don't know, and it's still to be discussed if it's really de-escalating. We will see over the next weeks, months, if some trades can be signed, deals can be signed or not, or if we will go full blown with tariffs. CPI. A few words about CPI. Here you have the US CPI. Interesting, the different components. Interesting is that durable goods are already re-accelerating. They are representing 20% of total CPI. Here the K point will be the diffusion or not of this rebound that will continue because of tariffs to the service sector. Here I took the example of medical care. Will it diffuse with the wages as a channel? Don't forget that wages are still too high in the view, or growing too much in the view of the Federal Reserve, 3.9%, the last data from the Bureau of Labor Statistics. So with the wages as a channel, will you have a diffusion to the rest of the services? That is what we will monitor. My favorite gauge for the US inflation are the haircuts. Haircuts, you have no trade wars, you have no dollar effect, you have just local services and price dynamics. And currently we stand at 3.6%. So just that to mention, we will speak about the Fed a bit later in a few moments. The price dynamics is still too strong in the eyes of the Fed to be comfortable. In the other developed markets, in the Eurozone, we are now on the target. It means, and that's why the ECB could lower its interest rates. We are close to the final rate in the Eurozone, around 2%. As I told you, Japan is under pressure. The last core CPI data surprised on the upside. Again, the idea is the Bank of Japan behind the curve? Will have the Bank of Japan to hike rates in emergency as the Fed had to do 2 years ago? That is the big question. So far, again, they are rather under pressure. Central banks.
Hey, Yann, we have
yes,
we have a couple more questions. Yann?
Oh, yeah, sure.
Yann? Question?
Yeah, I'd like to ask Yann, you're advocating in the short run, and maybe even in intermediate term, you're advocating a cautious defensive approach to portfolio management. What methodology or structure are you advocating as a hedge in the event that the results that the current administration is attempting to achieve come about? How are you going to benefit from that if you're not hedging the portfolio or structuring the portfolio for that result as opposed to a negative result?
You mean if I'm wrong and the portfolio goes up? Or how do I hedge the risks?
What I'm saying is your current methodology believes that the economy is questionable and there's risk. You want to take, how do you take advantage? How do you hedge the portfolio to take advantage that the economy turns around because what the administration is attempting to achieve is achieved? You get the growth. You don't want to be in a position where you don't get the upside. So how do you hedge the portfolio?
Okay. It's always difficult to get both sides, okay? There is one way, unless you do tactics. I trade too, so that's how I join both, but myself. So being very reactive, you can again step into more risk in your portfolio. So first remark. Second remark, I have a strong belief in steepening of the curve. If you don't have a recession, if everything goes fine and the US administration achieves it to lower the primary deficit, in the meantime, making growth accelerating, also thanks to productivity gains, IA, etc., which is possible, then you will have a very strong steepening of the curve. and your 10-year rates should be around between 5.50 and 6%. I have very strong steepening positioning in the portfolios and the recommendations. So that is the first hedge. The second one, I still have some carry. Okay, so the positioning on the emerging market side, on the debt side, should perform quite well. Then being defensive does not mean I'm not invested in equities. As I told you, so you will perform less, of course, than being in strategies that are very cyclical, okay? But you will nevertheless perform. I managing portfolios for many years, and I learned that it's very difficult to get always the best of everything. You are right, I'm rather defensive. So if things accelerate and the S&P goes to 6,000, that would not be very good for my positioning. Nevertheless, I have some positions that would perform better, like steepening or things like that.
The strengthening
The dollar
of
probably.
the strengthening of the yield curve, should growth occur, that would be translated into a stronger dollar, because the interest paid on treasuries would be significantly higher. So that would strengthen
Yes.
the dollar. Okay,
Yeah.
you concur with that.
Perfect.
That
All right,
would
Great.
strengthen the
Yep,
dollar,
Annabelle?
and given the rally that we had, so the strong depreciation that we had, and we took almost all the 10%, it's time to reload a bit of dollars.
Hey, Yann, we have
And
about
dollar,
10,
of course,
15
would be a
minutes.
way to benefit from that.
Yeah, 10 to 15 minutes. So let's speed up.
Okay. I speed up. Central banks, today, complex pattern for the Fed and for the Bank of Japan. 2 cuts, everybody agrees on that, market and the Fed, but the Fed is very divided. That is point 1, point 2. What matters for the economy are the long-term rates, as I said. So, and what much will depend on the data. Okay, if data continues to be strong, there will be no cuts, and steepening, bear steepening, as I said. And if there is a recession, you have then also a steepening, but a bull one. Okay. One point I want to mention about central banks. This is an indicator developed by the Fed linking the financial conditions contributors to growth, and we see that what has changed are the wealth effect. Okay, it has played an important role over the last month or last quarters here, and now it has stabilized. Okay, because yes, financial markets do not gain anymore. As I said, that everything is quite stretched, quite highly valued. So this wealth effect doesn't support growth anymore as it did over the last quarters. So I skipped the emerging market central banks. Just maybe a word here to illustrate in LATAM, very high real rates that made the debt, local debt there, very attractive, and Asian debt, where you have a lot of huge inflows since March, roughly. As the economy decelerates, the central bank has the room of maneuver. So you have a big and very interesting and profitable duration bet there, with a bull steepening in most of the countries, Asian countries. I use proprietary indicators to have a better guess, or among other indicators, about the probability of going into a recession. And that is exactly what I said a few minutes ago. The data still do not exhibit alarming patterns. It will come, but we must monitor exactly the situation, and particularly the labor market. Okay, unless here we have a strong way up, the probability remains not too high having a recession. I like to look at surprises, for the reason that surprises are the difference between expectations and real data. So expectations is what is priced in. So it makes it all the more interesting to look at the difference. And we see in May we had positive surprises on growth, but that is linked to the front loading of consumption and investment from March and April. Okay, in May comes out the data from March and April. So I hope I have clearly explained why I think we are in a late cycle. Here you are used to that with probabilities about recession, recovery, or strong rebound. Goldilocks, for me, Goldilocks cannot hold given the level of interest rates in the real economy. We are currently here in the late cycle, and the next step is a recession. I put a high probability, okay? A probability is 0 or 1 at the end, okay? So I just put a high probability. The call is not there yet, and the question will be L-shaped or V-shaped after that in terms of growth, okay? Not in terms
Yann,
of market.
Yann,
Yep.
Yann, Yann, can I take a vote? Just keep that slide there. How many people think there's going to be a recession in the next 6 months? How many people think Goldilocks? Can you raise your hand? Goldilocks? Recession? I see. I think the U.S. is a safe haven for money. I don't know, for capital. But so, Yann, everybody thinks Goldilocks here, or most everybody, about 80% are Goldilocks people. So we're going to find out.
That's what the equity market tells you.
I'm going to tell you something about how wrong we've been in the past. We've been wrong a lot. Like in 2010, we thought the Fed was going to raise interest rates any minute.
Yeah.
So you never know.
You know,
by the way, do you think the Fed is going to cut rates? Do you think the Fed is going to cut rates?
If the growth deteriorates, that will depend on where inflation is.
So if the Fed cuts rates, what is your scenario?
If they cut rates by one cut, I mean that will not change the pattern.
How many cuts do you need to get to Goldilocks?
Global macro pattern.
How many cuts do you need to get to Goldilocks?
Back to 2%.
Okay, keep on going. Any questions? Keep on going.
You know, being right or wrong is not the point. With my clients, important, it's the sparring partnership. We want to make sure we have discussed, thought about everything. Then we see what gets right, what gets wrong. Important is to be prepared. And in terms of investment, as I don't remember who said, it's not important when you are right or when you are wrong. It depends for how long you keep your position when you're right, and how much loss you have when you're wrong. You know, so this is the game actually. So what
can you give more color
to
Yann? Can you give more color to France does not collapse? Can you give more color to this prognostication on France?
France. France is in a tricky situation. France, here you have a graph of the relative positioning of the different European countries in terms of debt and fiscal deficit. France is a country where you have no political majority. Okay, you have 3 blocs that don't agree among them. So there is no structural reform that can be passed through. Okay, it's kind of a statu quo, and that is the problem. The statu quo currently. If you take the debt to GDP level, we are currently here at 6% deficit. The debt to GDP was at 113 last year. Will be 116 by the end of the year, and it expected 120 by the end of next year. So this is a graph I made last year in July after the election. to advise the clients to switch in their core allocation from France to Spain. I'm French. I have worked for the Treasury, so I'm sorry to have advised this, but those are facts. Okay, France is in a complicated situation with no big reforms possible, with little engines of growth, with sluggish productivity gains. So, well, how will the situation be solved? I don't know. Maybe the IMF has to come to France as it came in the UK or Greece at some stage. Somebody neutral coming to France saying, okay, guys, you must do that and that and that.
Wow. Okay, keep on going. We've got 5
There
minutes.
are nice stories in France. I mean, there are very good corporates, Eutelsat, etc. You have very nice corporates, nice sectors, very smart people. But the global situation of the country, its public finances, its public services, they are in a bad situation. That's what I mean. Okay, so if you have opportunities, look at every opportunity to invest in France in a bottom-up view, in a top-down view. The situation is very tricky. That's what I meant. Just
Fantastic.
to switch to
Yep, keep on going.
valuations. Yeah, as I have very little time, what did I mean with US are expensive, and not only US, okay? Many other countries. There are good reasons behind that, okay? The fiscal deficits continue to support income, buybacks at record levels. Earnings season has been very positive. The retail sector, who is quite smart, I must admit, has a great impact on market. Okay, but if you look at this chart here at the top bottom, this is the PE forward. Okay, simply put, if you buy at those levels, where are you? What is your return if you sell 10 years later? This is historical data. If you buy at a PE that is roughly around 21, 22, you are almost certain to lose money in 10 years. So has been in the past. Okay, so that's why I was answering to the question, to the first question. I would do tactics only. Okay, at current levels of valuations, given the fact that margins will be under pressure, the top line might be under pressure because of growth, because of growing costs, all kind of costs. Okay, so I would focus really on tactics and on sector allocation. When I was saying late cycle, it means there are some sectors that you can favor, okay? Infrastructure, food, retail, telecom, software, durable goods, those ones you sell them, semiconductors. And this kind of strategy outperforms, okay? So it makes sense, it adds value to have a top-down approach. Choose your sectors, pick your equities, and stay invested in equity. So to go back to the questions a few minutes ago, if there is a strong rebound, of course, I would benefit not as much as more aggressive portfolios, but I'm still invested somehow. Okay, so here you have the picture or one illustration. What I mean with the US being overvalued and quite expensive. And here, if you look at the relation between price to book, always forward, and return on equity, which is another way to show the price earning ratio, you see here the US, Taiwan are very expensive. You have some still in Asia, some interesting valuations. The question with EMs is always, do I take the currency risk with me or not? Do I buy the index or do I buy the future? I advise now to buy rather the future. For Europe, the situation is a bit different. This is 2012 and 13, so if you expect Goldilocks for the next 5 to 10 years in Europe, then the current level of price earnings is not too scary. If you think you are in 2006, 2007 period, then again, it's not a good period to invest in equities unless you do tactics again. Questions, maybe.
Hey,
if
Yann,
I have 5 minutes left.
Yann, I have a question. I have a
Yeah.
question. So you're talking about, Europe and the next 5-year outlook. What's the impact of increased defense spending? Do you think that's going to happen? Do you think that Europe will be bringing more manufacturing back to the continent? I mean, I think that somebody made a statement last week that China is now about 35% of the world's manufacturing, and that just can't stand. Countries have to bring manufacturing back. Any thoughts on that?
Defense spending, yes, that will of course stimulate some parts of the economy, particularly the high-end IT, etc. If industry comes back, it will come back in the around Europe. For example, in Turkey, in Morocco, in Romania, where the costs are a bit lower compared to France or Germany. You might have a reshoring process. There is no fiscal stimulus as in the US to do that, but you could still have some, yes. Positive impact in any case. And as I showed, many countries are not very indebted yet. There is some room of maneuver for more fiscal deficits, particularly at the EU, European Union level.
Great, keep going, keep going.
Yeah.
Hello, Yann.
Well, I mean, there are many other subjects, of course. If you want to speak about a country or another, here the sectors, I spoke about the allocation in terms of sector. Here we work on rotation. We will soon introduce the same kind of tool for the US. This picture shows you how violent the move has been on the long end of the curve. Imagine for Japan or even the US plus 60 bips over 3 months, given the sensitivity of the 30 years bonds. This is a strong hit, and that's why if invested in the US in bonds, we favor for months now the really short end and the T-bills. Okay, we don't like the duration risk in the US. We prefer looking for a duration in emerging markets, in other developed countries where the room of maneuver of the central banks is a bit greater. In Australia, it has been the case, for example, or in the Eurozone.
Yann, great, Yann. I want to get to closing, but I want to get your perspective on this Iran-Israel thing and economic impact. Obviously, Iran is kind of a linchpin of China's strategy, right? Belt and Road Initiative. It's the largest oil trading partner with China. Any thoughts on the impact on China from Iran and this conflict that's going on? What are your thoughts?
Okay, it seems like retaliation from the side of Iran has been quite muted. Okay. Anyway, the channel is our oil prices. Okay, I had a target for oil prices at $60 before the story started, the war started. I upgraded it to $70. Unless Iran steps in completely crazy retaliation, it means it sinks 20 boats in the Detroit of Hormuz, or it attacks Dubai or Emirates. Who knows? They might do that, but that would be committing suicide for them. So I don't think they are there yet. If that happens, this is a completely different story. Okay, and this we will have many problems if that happens. If that doesn't happen, we will be there with an oil price that is a bit higher in order to represent the higher risk. You have everywhere a lot of spare capacities, around 6 million barrels in the OPEP, or maybe a bit more. So you have enough spare capacity to absorb, even if Iran would stop to import. There are enough producers for China and the rest of the world to buy oil. Remember,
Got
oil
it. And
consumption is
one
yeah.
One other question. switching to China, you had said that China housing market was coming back, but I've read that in 7 of the provinces they've run out of capital for allocating new mortgages, and there's a problem in those 7 provinces. What happens if China housing market plummets again? Any thoughts?
No, I didn't say it comes back. I just said the second derivative is now positive. That means housing prices still contract, but they contract at a slower pace compared to 2024, for example. Okay, but they still contract at a pace around 5% a year. You still have a lot of inventory. You have roughly between unsold, unfinished, empty apartments. You have roughly 80 million still inventory on the market. So it's not finished. Okay, it's not finished. They have not cleaned up the sector yet. The sector still weighs 20% of GDP. Remember the crisis in 2007. Spain, that was considered as too much housing sector, had 12%. Okay, so it's not finished. It's just contracting less strongly.
Fantastic, great. Did you want to take 30 seconds to wrap up, or are there any other questions here? 30 seconds, just give us your worldview and what you're doing in the next 30 days to implement your strategy here.
My strategy is already implemented. I mean, we had a strong rebound after the U-turn. That is, the U-turn happened because of interest rates. That was the only reason behind. Mr. Benson convinced Mr. Trump to change its stance. Currently, so I'm fine with my positioning. Currently, I'm in a wait and see mood. Wait and see. I will look at the data. I rather think that the macro guys are too optimistic. Now we'll see. And I do tactics. Okay, I trade a bit every day.
Fantastic. Well, Yann, this is really a fantastic presentation. Thank you so much. Enjoy Zug and the beautiful view there. And we hope to have you on again. Thank you.
Thanks for inviting me.